Most people invest in stocks without understanding the why. So these are the 5 numbers I look at every single time I invest in a company. This is coming from a 22-year-old semiconductor engineer with 6 figures invested. Number one is the PE ratio, which stands for price to earnings ratio. This tells you how much you're paying for every dollar of profit the company makes. A simple example is if a company is trading at $100 and they make $5 per share, your PE ratio is 20. The S&P 500 has an average PE of around 22. So when you look at a company like Palantir with a PE above 150, you're paying a massive premium. Low PE can mean undervalued and high PE can be overvalued, but it just matters about the context of the stock and company. Number two is revenue growth, and this tells you if the business is actually getting bigger over time. I don't care how much a stock is worth if the revenue is shrinking. That just means the company could be based on hype alone. What I look for personally is a 15 to 20% revenue growth year over year, and anything below that, I don't touch. Number three is EPS, which stands for earnings per share. This is where you take the profit of the company and divide it by how many shares that exist. If the EPS is growing every quarter, that means the company is becoming more profitable over time, and that's exactly what you want to see. If the EPS keeps missing analyst expectations, that's a red flag because that means the company is not that profitable over time and Wall Street does not think that it will be growing. Fourth is dividend yield, and this is the percentage of the stock price that the company gives you back in cash just for holding the shares. For example, if the stock is trading at $100 and you get $4 a year in dividends, the yield is 4%. This matters more for stable companies like banks and utilities, and if the yield for a company is too high, that could also be a huge red flag. Take a look at the ticker TSLY. This is Tesla's high yield fund, and the yield is so astronomically high, but the stock just keeps plummeting. And number five is debt to equity ratio. This tells you how much the company has borrowed versus how much it owns. A ratio of 2 means the company owes twice as much of what it's worth today, but that's not automatically bad. Some industries like banks carry a lot of debt, so that's normal. But for example, you look at tech, if they have a really high ratio, then that's not good, especially growth stocks. So these are the 5 that I check before buying any stock. This is not financial advice, but follow me for more breakdowns like this.